one of the easiest to use, easy to understand, and something that you can use right now, today, on your next trade to make some serious potential profits. It also happens to be 100% free through TradingView. What am I talking about? I'm talking about, of course, moving averages, a key part of my trading strategy, which we're going to dive into right now. Yes, g'day folks, it's Tex here from unitytradinggroup.com. If you're picking up what we're putting down, hit that subscribe button, turn on that notification bell, and get instant updates every single time that we go live for market updates or produce new educational content like this, which you're going to be seeing a lot more of from UTG in the very near future. So let's get into this. We're talking about moving averages today. For a long time, not something that I used, but once I did start using it, it unlocked a whole world of, let's say, better trades for me. That's probably a good way to put it. It made me a lot more of a successful trader when I applied a real emphasis on understanding moving averages. But there's 3 different types of moving averages, and if you want to get your hands on a very free EMA tool that we have created, leave a comment below and like this video, and if we get enough interest, I'll release this indicator 100% free, which I created for this video. If not, just jump on TradingView and type in one of these moving average types that I'm going to talk to you about, and there will be something there undoubtedly. So let's talk about the different types of moving averages. I'm going to use Unicon because we can flick between them very easily. So we've got 3 different types of moving averages. We have 1, our simple moving average. 2, we have our exponential moving average. And 3, we have our volume weighted moving average. You can see when I flick between the 3 of them, how those lines changed. And we're going to talk about what exactly they are. What I'm going to focus on at the moment is SMAs and, more importantly, EMAs, because I use this in my trading strategy, and I'll tell you why I feel they're the best. But for you, play around with them. There may be some differences in there that you find perfectly align with your TA and perfectly suit you as a trader. So let's have a look at SMAs. They are, it's called a simple moving average. And if we look at our settings here, which will be consistent across every moving average type, we have these lengths of 10, 20, 50, 100, and 200. What do these numbers mean? Well, it means the 10, 20, 50, 100, 200 are taking that many candles in the past to plot levels of interest in the future. So that's taking 10 candle data points, 20 candle data points, 50, 100, and 200. And that's why I like this so much, because you've got real data from previous price action to tell you where price may be headed in the future, and it plots out those levels for you. Pretty cool, right? But there is a little bit of a flaw with the simple moving average, and one reason why I don't use it. The name implies it. Simple. It's a lagging indicator, really. It smooths out price action and smooths out volatility to give you lagging information. It's not immediate. We want something that's more immediate. It's telling me right now whether I want to consider an entry or an exit, whether I want to consider taking profit or shorting or longing or loading up on spot buys across any market. Doesn't matter whether it's Bitcoin or otherwise, or crypto or otherwise. So how do we mitigate the issue of something that's a little bit lagging? Well, very easy. We go to our EMAs. So what I'm going to do is I'm going to turn this off, and I'm going to turn on our free EMA tool to talk about this. So EMA refers to exponential moving average. So all of our moving averages are calculated a little bit differently from another, but this gives a little bit more weight to recent price action. So it's giving us more immediate data, as I mentioned, than the simple moving average, and I find it works better than the volume weighted moving average as well. So it responds faster to price action by distributing weight more to recent periods. So let's have a look at our settings here. We have 10, 20, 50, 100, and 200. I've explained what they mean. Some people may go 9 and 21. For me, 10 and 20 works perfectly. So what we're going to do right now is we're going to talk about a basic strategy using our 9 and 21, or in this case, 10 and 20 EMA. So what does this mean? In the simplest of terms, when we are trading below our 10 and 20 EMA, we are in a short-term downtrend or bearish environment. When we are trading above our 10 and 20 EMAs, we are considered to be in an uptrend or in a bullish environment. And really, we want to see a couple of candle closes above these EMAs because we have what's called a fake out here. So you can see that we've got price action breaking above and a little bit of an evening star pattern here, which I won't get into what that is. You can find it on our website. We have price action trending above, and then the two preceding candles. This was indecision, but this was bearish price action. So really what we want to see is when we see price action trending above our 9 and 20 EMA, we want to see something definitive like a nice bullish engulfing candle or a couple of nice decent bullish candles when we close above. Now, if you've missed the break above our EMAs, you could wait for something like this, a pullback to a little bit of a cradle here where we've got price action respecting this EMA really, really beautifully. And then the preceding candle from that is a nice bullish engulfing and we're off to the races again. And you can see how when we've headed up, we've gone up and above, we've respected it, we've gone up and above, respected it before ultimately falling backwards and then heading into this downtrend where this now becomes a level of resistance. So let me break that down very, very simply for you. When we are broken above our 10 and 20 EMA and close above definitively, we are in bullish or an uptrend territory, and we then look to these EMAs as levels of support. When we break below our 10 and 20 EMA and close below, we are in bearish territory or a downtrend, and we are then looking to these candles as levels of resistance. And again, you see this fake out here. We had a little bit of a consolidation period on the 1 day before we trended back down. We didn't really have any sort of heavy bullish candle or bullish engulfing candle to tell us that we were headed back up. And you can actually even see by the angle of these EMAs too, that's giving you an understanding of whether we are going up or we're going down or we're kind of trending sideways. So the smoother and flatter the moving average is, the more of in a range you will find ourselves. The steeper the angle of the EMA up or down, the more defined the trend is. So that's a very, very easy way to understand it. And as I said, if you want a more definitive SMA or EMA rather trading strategy, leave a comment below and I'll record a dedicated video to it. I didn't want it to drag on too long with this. Now, keeping in mind, we've not even put any trend lines or support or resistance or Fibonacci or anything on this chart at the moment. This is purely just using EMAs. So what happens when we break below or above our EMAs and we're kind of flying blind here? We don't really know anywhere above us where may be considered a level of resistance because we're below, or a level of support when we're headed down. Well, that's really easy. We just turn on the next moving average. So we've got our 50 moving average, and then we've got our 100 moving average, and then our 200 moving average. So let's have a talk about that. So what happens when we break above our 9 and 21 EMA? Well, the next immediate EMA above, in this case being the 200, is going to act as a level of resistance. And we want to see a nice, decent close above that, where this becomes resistance and this becomes resistance. And you can see how our trend, our EMA angle lines are pointing down. Well, that means that our longer term trend is a downtrend. So you can see that we've broken above, our 200's become our resistance, and we've rejected. We've come up, broken above all of these, where we may be looking at this going, okay, excellent, we've broken above our entire EMA cluster, and then when we pull back, we may not be considering any exits until we break below our EMA cluster. Do we want to take a chance that this EMA cluster here will act as a level of support? Because what you'll see is when we have a cluster or a tightening of our EMAs, or a group of them within a very small proximity of one another, it acts as a little bit of a blanket when we're above it, or it acts as a bit of a wall when we are below it. So we've got all these EMAs clustered here in this position. We know that there's a good chance that this is going to act as a level of resistance. And then when we break above it, we're off to the races, and then we start seeing levels of support for our more immediate bit of data here. So we've broken below this 10 EMA. This is where we would be considering our next level of support. and so on and so forth. But what you must consider is that as candles close, the position of these EMAs will change. They will not remain in this spot forever. They will remain in this spot for a short period of time before continuing up. But we can see we've got divergence, we've got separation between these moving averages, and they're all trending up. So it means in the overall scheme of things, we're still in a pretty healthy uptrend. And you can see that we're not making any lower lows from this period here. We are still making higher highs as we continue up on Bitcoin. So it's a very, very simple way of using EMAs when we are trending above or below our EMA lines. Now, you may then go and add something like an RSI, for example. This is a free RSI tool which you can find on our TradingView account. Just search for Unity Trading Group on TradingView, and then when we have a cross above our 50 MA, have a cross above our 50 RSI line or in bullish territory, and have crossed above our EMA cluster, we've got two definitive levels there telling us that we're in bullish territory. So from that, we may be considering an entry. So we take a position, and then we're not exiting out of this position unless we close back again below our EMAs, our entire EMA set. So if we go over to something like our ETH/USD chart as well, you can see how well this is respected. And one thing that some people might do is they might change the 100 to an 80. Now, I like this at sometimes as well, because I find that it does give, in certain instances, a little bit more of an accurate level over the 100. So really, between the 10 and 20, I leave that as is. I keep the 50 and the 200 as is, and then I will sometimes fluctuate between the 100 and the 80 EMA, because if you just simply change it and look back in the past, you will see how well it's been respected. So that's kind of the only one that I will really change. Now, if we break below our 200 EMA, which is really considered the last line of defense, which you won't often find on ETH and BTC looking back, you can see that we sometimes have a break below, but we recover quite quickly, and there's not too much of a downtrend underneath the 200 MA. How do we find the next level of support underneath that? Well, we're on the daily time frame, so we'll go to the two-day time frame. And you can see that this then becomes our next level of support, which we didn't manage to hit. So we can see we had a nice little double bottom here. And if we go back to the one-day chart, we broke below. We had a doji or a hammer here as well, and then it was preceded by a really healthy bullish engulfing candle, like almost like a morning star formation here with a double bottom, and then RSI heading in to bullish territory. But as we break below, or as we close below here, you can see how our 200 and our 10 and 20 EMAs became levels of resistance. Now, you can also see when you're trading with these how quickly the 9 EMA will start to arc and curve before the 20 EMA does. And then the same thing again with our 50 and our 100 EMA. So as a beginner trader, we're looking for immediate information, and that would be on our 10 EMA arcing up before the 20 did. So that's a very, very simple way of understanding moving averages. I won't go too far more into that beginner trader moving averages strat. If you want to know more, leave a comment below and I will create a video solely dedicated to a trading strat with a couple of other tools and things that I use personally for myself to make entries. But that's pretty much it. It doesn't really get much easier than that when we are above our EMA cluster or our 9 and 20 or 10 and 20 EMA. We look for the 50 to become the next level of resistance, the 100 and then the 200. When we have cleared all of them, we are then looking for each of them as a level of support, and when one breaks, we head to the next. You can see that very, very clearly here, and very, very clearly here as well. So conversely, when we are below it, each of them becomes a level of resistance. We break below the 10 and 20, 50 becomes support, resistance rather, and then same for the 100 and 200. Very, very easy to understand, very, very easy to use. It's free. Leave your likes, comments, and shares below. And then if we get enough information on this, I will leave a comment with a link to this in TradingView. So I hope you understand that. I hope you enjoyed that. Doesn't get much easier than the moving averages. And you can see why they're so simple, effective, and why I use them so much in my trading strategy. Thank you for joining us. I'm Tex from UnityTradingGroup.com. I'll see you in the next video. Bye for now.